Sorry about that, guys. My phone did the exact same thing to me again. So we are now fully on the computer, and I wanted to make sure I'm not getting a feedback before we start.
No feedback.
Okay. All right. Let's go ahead and start for real now. Good afternoon, and welcome to our third webinar in this series today. My name is Danny. I'm with the learning team at Cherry Bekaert. Just want to go over a few quick housekeeping items before we get started. For audio during today's webinar, you may listen through the phone or the computer speakers. You can choose your audio under the audio tab in the menu to the right of your screen. To earn CPE for today's webinar, please make sure you answer all the polling questions. Make sure you click the submit button to submit your answer. Instructors will try to remind you of this as each poll appears. We will be distributing CPE certificates via email in the upcoming weeks. The instructors and I will answer questions in the question and answer pod. We will try to answer them throughout the webinar. For the housekeeping announcements, and I will turn it over to the team.
Good afternoon, everyone. I'm Amanda Adams, Cherry Bekaert's nonprofit tax services leader, and it's my pleasure to introduce Andrew Schultz today. He is General Counsel of Arabella Advisors, which was founded in 2005 to provide strategic guidance for effective philanthropy. Since then, they have helped hundreds of clients representing more than $100 billion in assets increase their philanthropic impact. As General Counsel, Andrew manages Arabella's legal affairs, provides legal advice to the firm's leadership and staff, and ensures that the foundations and independent nonprofits Arabella helps to manage are in compliance with the law. Prior to joining Arabella, Andrew was Executive VP at Foundation Source, the largest provider of support services for private foundations, and VP of Legal and Government Relations for the Council on Foundations, which is focused on providing educational resources and advocacy for the philanthropic community. Andrew is nationally recognized as an authority on private foundations and has been a frequent speaker at conferences related to philanthropy. Andrew, thank you so much for joining us today to share how the nonprofit community can benefit from impact investing.
Great. Thank you very much for having me, and welcome everyone. Good afternoon to some of you. Good morning to others. Thanks for sticking around for this third session. I think a lot of people are new to impact investing. Some people have been doing it for a while. I think it's a bucket that covers a lot of different things. So this is really very much an overview. As you can tell from my background, I come at this presentation a lot from the perspective of the funder. But I also think that, you can take what you've learned through this session if you are an organization that is also, a fundraiser, looking for ways in which to increase the revenue that you have, thinking through the way impact investing opportunities might be another way in which your partners, your funders work with you is something that could be valuable. So that's not the perspective of this presentation, but I think as you go through and you listen, I actually work with a nonprofit, the New Venture Fund, which is both a funder and a grant seeker. And so there's some of these where we play both roles, where we're both a recipient of impact investments, but we're also deploying philanthropic capital as impact investment. So I hope that no matter where you are and where you sit, what your level of experience is, there's something you gain from this conversation. I'm going to start off by providing a little bit of context. And when I first came to the sector in the late 90s, I was in private practice. There was this, most grant-making institutions that were endowed followed this model where they had 95% of their assets they thought of as their investment assets, and 5% they deployed. And the two sides of the spectrum where all the mission and the program, the operations happened out of the grant making side. And then the 95% was really, the sole purpose of that was to preserve the endowment. That's not universally true, right? Obviously, there are early adopters and people who forged the way for impact investing type things, but even in the late 90s, it was still pretty uncommon. I mean, if we look back at the rules about program-related investments, those have been in the tax code since the 60s, and the concepts before then, but certainly it hadn't been adopted. And in fact, one of the stories I tell is when I first joined the practice of law, there was a debate raging about whether or not it was universally imprudent to have more than 20% of your endowment in equities. If the 80-20 rule, 80% in bonds, 20% was the bridge that you couldn't cross. And so to think about where we are now and the way that modern investment portfolio theory and the way that people think about putting their assets to work through alternatives and that sort of thing has really evolved over time. And not everybody's there yet, but I think more people are thinking that way than used to. So where we are today is a little bit more of a continuum of the way we think about the assets that we deploy in furthering our charitable mission. And I'm going to be talking largely about the Section 501c3 organizations, but you also see other organizations, social welfare organizations under 501c4, even labor unions and trade associations under C5 and C6 are thinking about the way in which they use all of their resources to advance their mission. But I've got the continuum laid out here. Obviously, grants is the traditional way. It's where you deploy funds with no expectation of getting them back. All the way at the other end of the spectrum are, just your endowment investments, where you're literally just shopping on the market, trying to generate the best return within the context of your investment portfolio. What's your risk? What's your asset allocation? And really the driver there is how do you put all that stuff together, just balance risk and return to get the most out of your investments. And we're seeing more people playing around in the middle. Recoverable grants is an idea that you make a grant, but there's some opportunity for you to get it back depending on what happens with the grant. PRIs, program-related investments, the terminology that comes from the private foundation context, but others are using, which is things that look like an investment. They may be a loan to a company or, a short-term or a long-term investment, but where the purpose is mission driven and not because of the return. Crossing the line into the way we think about our investment portfolio, still making investments that are market driven, but thinking about the due diligence we do on the companies that we're investing in, the investment opportunities, and while the driver may still be a return on the investment, thinking about what are the other characteristics and aspects, and as between two investment opportunities, let's take the one that is aligned with our mission and our values over the ones and just not being agnostic about it. And so when we talk about impact investing, it's this whole spectrum. And you will hear funders talk about grants as investments. They'll say we're making an investment in this nonprofit. And so impact investing isn't a clearly defined term, but it covers this whole spectrum. And there are different ways in which, and I'll talk about that later, we'll go through some examples of different things. But before I get to the rules, it'd be nice to hear a little bit from you all about who you are and what your experience is. So this first polling question, which will get queued up in the polling tool, asks you about your organization's experience with impact investing. I've got a polling question later that's about you personally, but where you sit right now, the organization that you represent, what is your experience with impact investing? Are you new to this conversation, or have you been dabbling in it for years? And so just as a reminder to those of you who are seeking CLE credit for this, please be sure to participate in each poll. It's one of the verifications we need to do to make sure everybody gets their CLE. So please take a minute to fill out the poll. And I think it takes about 30 to 45 seconds to get everyone voting. We have really excellent voter turnout. It's been the story of 2020, is everybody participating in their their voting and look at the results. So that's great. It looks like, well, I'm grateful to have so many of you participate in the poll. Most of you are still learning and haven't taken the dive into this, so that's perfect. This presentation is set up well for you. And on our seasoned experts, I wish we were live. I could call on you to help me teach this, but hopefully there'll be some things we get going forward. As I promised, there's a second polling question. Now, this is about you personally, not the institution that you're working for, but your personal experience. So this is poll question number 2. Who are you? What do you know about impact investing? And we've got experiences. We've a lot of new people working with institutions who've been playing at impact investing for quite some time. And you may be one of those people. You also may be a seasoned expert who happens to be at an organization that hasn't taken that plunge yet. This isn't something we're going to talk about much, but I often find that there's staff who are really eager to engage in more creative ways about deploying the assets. But getting your board and your leadership and frankly your other stakeholders to come along for the journey may take a little bit more doing. So it's not surprising to see that the numbers look about the same. That we have, most of you are new and still learning, which is great. I'm really excited to see so many people who want to learn more about this because I think it's a really, really powerful tool. So great. Well, now that I know who you are, let's dive a little bit further into the material. As I laid out the continuum, I just wanted to give a little bit more detail. We tend to think, I tend to, and I think many tend to think about, are you an impact first investor or a finance first investor? And let me be clear, each investment has a different sort of character to it. It's, organizations will look at their total breadth of activities and they will decide for this particular investment, what is it? So, screening social impact first, then possibly there may be a possibility of a financial return. That's the PRI world where it's program first, but there's some opportunity for investment return. Mission-related investing is again where the driver is finance first, but then within that context of that, looking for a positive social impact. Obviously, it's a continuum, and so there's some things that maybe hit about 50-50. Some things are, just a little bit more mission. Some things are just a little bit more. There's no reason to try and draw a bright line, but it's really important to understand when you go into something what your expectations are. Because some of what we're going to talk about is like, were we successful? Were we successful with our impact investing strategy? And if you don't know why you're getting into the investment at the outset, it's virtually impossible to make a determination at the end whether it was successful or not. I think the other thing is, we rarely make impact investments in a vacuum alone. We're often working with others and pairing our investment. And so it's also important to understand what your drivers are so that when you sit down with other stakeholders and other investors, you know where you're aligned and where those differences may arise. So we're looking at donors, investors that you're looking for high social impact with below market rate financial return versus high rate return with some social environmental impact. It's just important to know these things at the outset. So let's talk a little bit about terminology so we're all on the same page. I've used PRIs a couple times. So a program-related investment is a very specific term that comes from the Internal Revenue Code and the rules that govern private foundations. And private foundations are heavily regulated. They have been since the 60s. And there are a lot of different rules that apply to private foundations. How are you deploying your funds? Are you using the right amount to support your mission and vision? When you're making investments, are they prudent? Are you meeting a federal sort of prudent investor standard that's set forth in the tax code? And that a lot of that's where this, stark division in the early part of the 69 Tax Act, where we sort of had our investment portfolio and our grant making portfolio, was that some of these rules, unintentionally, I think, push people to that. So the program-related investment rules talk about when we're engaging in activity as a private foundation that has some of the characteristics of an investment, but is really program driven. What do those rules mean? And so PRIs are set forth in section 4945, and most PRIs, certainly historically, are where a private foundation is deploying funds to a for-profit company or some business concern. And so the Internal Revenue Service set down, or Congress, and then in the Internal Revenue Service, enforces the law, said, listen, if you want to take advantage of these rules, first and foremost, the primary driver behind the investment has to be for charitable purposes. It cannot be a significant purpose that you get an investment return. That includes either growth or revenue. Those things can be possible, and they can even be expected or hoped for, but it can't be the primary reason why you are engaging in the PRI. And then for the sake of completeness, you also can't use PRIs as a end around the prohibition on electioneering and lobbying that private foundations are prohibited from doing. If you meet the investment criteria, then there's a lot of positive things that flow from that. So first and foremost, it counts towards your payout. So if you deploy $1 million as a PRI, it counts towards the distribution requirement for private foundations under 4942. Section 4943, has rules for private foundations that prevents them from making overly speculative or risky investments with their endowment assets. And because the very nature of it being program driven and not for investment return, once something meets the qualifications as a PRI for a private foundation, they're exempted from the excess business holding rules, and you don't have to worry that the investment will fail and you'll suffer under the 4943 prohibitions. Oh, I'm sorry. I was talking about the Jeopardy investments. 4943 is actually about excess business holdings. I apologize for that. 4943 says that no private foundation can own a controlling interest in a company. And again, this is a situation where if it counts as a PRI, you're not subject to the 4943 limitations. You can invest in more of a company or a business than you would as an investment because it's not an investment. It's for purposes of promoting that return. The one thing I will say is Section 4945 for private foundations still does require people to exercise a form of expenditure responsibility. And again, that's to make sure that the purpose is primarily charitable and that you've done the appropriate due diligence. So those are the advantages. Now I say that because PRI comes from the private foundation rules, and that's where we get the terminology. We're in an era now where a number of public charities, community foundations, and others are making things that look like PRIs. They follow basically all of the same rules. Public charities don't need to worry about payout. They're not regulated that way. They don't need to worry about excess business holdings, they don't have to do expenditure responsibility, but it's a useful terminology to sort of explain what the nature of the activity is. And so you will see in this day and age people using the terminology PRI, even though they're not strictly speaking a private foundation. But if you want to go look up the rules on PRIs, you're going to be in the private foundation rules in the tax code. So for everyone else, and private foundations included, there's other legal considerations to think about when you're thinking about impact investing. So I said only PRIs are defined, and then only for PFs. All of the other things we talk about, mission-related investments, recoverable grants, those sorts of things, there's no definition for them. It's just things we've kind of come up with to sort of talk about the different activities. First and foremost with everything is going to be charitability and private benefit. And the private foundation rules are set up to make sure that the way these funds are deployed is always charitable. That's what the due diligence of expenditure responsibility leads us to. But everyone doing this, you really have to look into like, what is the investment? Not only are the purposes that we're trying to achieve charitable, but is the way in which we're doing it reasonable? What are the terms? Are we, getting enough in return in terms of public benefit that it justifies the investment? Again, this is all on the mission-driven side. Once you're on the investment side of your portfolio, we don't have to worry about these things. But if we're deploying these things and we're saying this is charitable, it's mission-driven and not endowment-driven, we need to make sure it's charitable, that there isn't private benefit. We also need to be careful about who we're co-investing with. And I think within the private foundation community, it is a somewhat common trap that, the people who run the foundation also have their own wealth. And, there are opportunities that arise where the family or the individual or the company may want to invest for their own return reasons, but there's also a social aspect to it, a program aspect piece, and side-by-side investing where the foundation and family members invest their own assets side by side in the same opportunity is possible. You have to be very careful about that. You have to work closely with counsel to make sure that the way that the foundation or the nonprofit is investing doesn't benefit insiders, family members, donors, board members, et cetera. So I just flagged that as something. If you're out there investing completely separately as a nonprofit, and not doing side-by-side investing, you can't invest in companies owned by the family, those sorts of things. But there are legal considerations if you're kind of in a cozy, if you're leveraging joint assets, foundation assets and private assets, you have to be very careful about that. And it's beyond the scope of this to get into what those nitty-gritty rules are. So I just wanted to flag that for everyone, to pay attention to who your co-investors are. On the farther left side of the spectrum, when we talk about grant making, we're not talking about things that are PRI-like. We're looking at, grant making, recoverable grants. It is entirely legally permissible for charitable institutions, private foundations, and other charities to make grants to non-charities. You can make grants to individuals, but they're very specific rules, particularly for private foundations, and then it's best practice for public charities to follow those rules as well. And so again, it's a really powerful tool to think creatively about the way you do your grant making. And if you don't need to do a loan, if you don't need to do an equity investment in a company for program purposes, but a grant will do, by all means, use the grant rules, but certainly follow the special rules for grants to non-charities and individuals. Another thing to consider is fiduciary duties. And I mentioned the Jeopardy investment rules under 4944, but there's also state-based prudent investor rules. And a really interesting topic for which I don't think there's a well-settled answer, but I think most people are comfortable with is, to what extent can you, on the investment side of the spectrum, when we're, if we're investing our endowment assets, for a rate of return, but also with a social goal. To the extent that we sacrifice potential returns for social benefits, what does that mean under the prudent investor rules? Most states have now enacted rules that allow companies to have sort of a corporate soul, so to speak, and where the way in which they conduct their business can not just be purely profit driven, but can also contemplate, social benefit for society, and you don't have to worry about shareholders suing the company for being too nice and not making enough money. But there are a number of questions about the duties of directors, both of nonprofit corporations and for-profit corporations, where they potentially forego revenue and returns and profit for societal benefit. And I think within the charitable sector, I'm unfamiliar with a single situation in which a director has been charged with breach of their fiduciary duty because of the way in which they pursued social good through their endowment investment. But it is something to be there. And really all it does is it says, don't ever forget that you continue to have a duty. Furthering social good is critical and important and mission related. But you still have to be prudent about it. So being thoughtful and strategic about to what extent you're going to leverage your endowments to promote mission-related and social justice issues and goals. How does that fit into your overall investment portfolio? And I think what I would say the practical guidance is, as long as you're being thoughtful and reasonable and not just gambling, you should be able to do anything, but I flag it as something that people should think about and be aware of. Continue to be reasonable. It seems to be pretty good guidance. And then just sort of in the last on this laundry list of legal issues to be cognizant of is unrelated business income tax. And if you don't know what UBIT is and what those words mean, congratulations. I think that's a little bit of a success story. It's not the most exciting topic, but charities, private foundations, and all charities are, by definition in the tax code, are required to engage in exclusively charitable activities. From time to time, organizations engage in business activities. And so the IRS says we're not going to revoke your exempt status, but to the extent that you're engaged in an unrelated trade or business and you derive income from that activity, your organization owes income tax on the revenue that it derives from that unrelated trade or business. Because of the way that section of the code is written, there is a provision that says debt-financed investments trigger unrelated business income tax. If this is news to you, it's okay. Just remember the general idea that when you borrow money to invest, to the extent that you invested with borrowed money, the profits you make using that borrowed money that you invested are taxable at the regular corporate rates. It is not fatal to your tax-exempt status unless you do an ungodly amount of it. But if you have some leveraged investments that are debt financed, you will owe some income tax on the gains that you make. Now, the corporate tax rates are relatively low, and therefore it may still be worthwhile doing. But we often see hedge fund investments, which are leveraged investments, which are technically debt financed. Depending on what investment you're pursuing and how you're pursuing it, you may, this is again on the investment side of things, if you're doing mission related or screened investments and they happen to be debt financed, you may end up with unrelated business income tax. Most people don't need to know this. You need to make sure that your accountants and lawyers know this. But I wanted to make sure to raise it just so that you're aware that you don't just go plunging off into making investments in all sorts of vehicles without understanding what the legal rules are. So more practical challenges. And I certainly don't want to scare people away from impact investing. I definitely want to make sure that you're thinking about all the things. There's an article listed at the end in the list of materials at the back which is, I think, an excellent article. I think it's the Stanford Social Innovation Review about whether or not impact investing makes sense for your organization. So in addition to being aware of the legal rules that I laid out, there's some practical challenges like impact investing typically by definition, especially as you get into that area between program-related investments and mission-related investments on either side of sort of the impact return side, they can be complex and they require staff capacity, not just financial knowledge, but also program knowledge. Often in larger institutions, the investment team doesn't know that much or anything about the program activities of the institution, and similarly, the program staff don't know that much about the investment side. And so, some of these things bring those two teams together. And if you're smaller, that team is often one or two people, if that. And so, the staff capacity to understand both the investment side and the program side, regardless of whether the program's driving and the investments the second seat, or the investments driving and the program's the second seat, you still need good communication and understanding on all those pieces. Another practical challenge with impact investing is it takes scale. I once had someone talking to me about how they could set up an impact investing program, and they wanted to put $50,000 to $100,000 in it in a year, and that's theoretically doable. It's nearly impossible to have meaningful impact unless you're putting meaningful resources behind it, and the practical and logistical challenges that go into it really do require scale. And again, I don't want to suggest you can't make really powerful impact investment type deployments. It's to smaller companies and organizations, but really, if you want to move the needle, as with most things, scale is important, and you have to be thoughtful of that. Also, the transaction costs if you're talking about either a PRI or another kind of investment where equity is involved, and if you're going to hold it for a period of time, you've got finance and accounting rules, which are the last bullet on this slide. But that relates to scale, because those transaction costs, as a percentage of the investment, they'll be much higher with smaller investments than with larger ones. Liquidity, I don't find that for most people this is a huge concern, but it's worth mentioning. Often in order to achieve the change you want, you need to lock up assets for 3, 4, and 5 years. And then that's going to affect your ability to do future work. I once was working with an organization that kind of got all gung-ho on this, both in terms of combination of sort of their impact investing strategy and long-term support for grantees. And they did it pretty aggressively for 3 years, and they got into year 4, and they basically realized they'd already sort of pre-committed all of their assets, and they just didn't have anything much left to play around with. And I don't mean to say play around. I don't mean to suggest it's a game, but they had less assets disposable to meet sort of current needs, because they'd pre-committed them in prior years. So think about what you're locking up, how much you can afford to lock up, how you want to balance that need for scale, but also the need for the liquidity to meet changing needs as they arise. There can be legal fees and other transaction costs, which I mentioned. Certainly when you're negotiating with a for-profit company and that has other investors, and what those notes and debt instruments may look like, those typically generate legal fees. And maybe lawyers you're not used to working with. So the lawyers that you need to help you structure those deals may not be the same lawyers that you've been using for your general charitable purposes and mission. Unlike grant making, I'm sure some grant making is adversarial, but in the charitable sector, we tend to have everybody, y'all get along kind of approach to things. But, that's not necessarily how these negotiations work when we get to negotiating investments in companies, whether it's program driven or investment driven. And you may just be buying into an opportunity that's an off the shelf that exists, but in most of the PRI type scenarios, you're really going in and you're structuring a new deal with new concessions, and those can be adversarial in a way that we're not used to. Social impact is very difficult to measure and quantify. So that's the other thing I think when you're dealing with your boards and other stakeholders and what have you achieved. That's not to say that it's impossible. Quite frankly, I think grant making can be hard to measure and quantify as well. So I don't think that's necessarily a big negative, but you do need to think in advance about what your strategy and your goals are and what success looks like. Often, and then I've already mentioned finance and accounting. I'm to say there's always a pretty long, often these investments really take time to mature, and so we need to think about, what the long-term reporting and monitoring is. So having talked for a little bit and lectured at you, I'm gonna go to our next polling question, which asks you about which investments you and your organization have been involved in. And, I've listed recoverable grants, guaranteeing loans, direct loans, convertible debt, which is where it starts out as a loan and then becomes an equity interest or an equity. And if there's something I've left off the list that you've done, I apologize, but I think there's an other option that you can pick as well. Great. Looks like a lot of people have done equity investments, and that's great. I think that's the deep end, right? That's where you get in. Recoverable grants are great. I'll just talk for a second while you finish the poll. The lawyers sometimes debate whether there's a difference between a recoverable grant and a loan, and I think finance and accounting people and lawyers might have a different view. My view about a recoverable grant is that the premise is that you're not likely to get repaid unless a triggering event happens, and that triggering event causes the grant to get repaid. Whereas I tend to think of a loan as the expectation is that it will get repaid. There's a possibility that expectation may not pan out, but really the difference between me and recoverable grants is it's more likely than not that it won't get repaid, whereas with a loan it's expected that it will get repaid, but and sometimes that may be a distinction without much of a difference. Great. Well, excellent feedback. I really appreciate. Let's go on to the fourth polling question, which talks about now based on the work that you've done, what's been your experience with your overall results of impacting investing across the spectrum? And again, I think part of what I'm trying to get at here is impact investing isn't for everyone. It's not something you should just do to do it. You need to be cognizant of what you expect to get out of it, and then really think about whether it was worth it. And you're not a lesser institution because you choose not to do it. And you're not a lesser institution no matter what you choose. You just have to choose what's right for you. So, really, really great to see such a wide range of answers coming in. Some who've tried it and clearly realized just that the juice wasn't worth the squeeze, but for some of you, it seems like it's been maybe transformative is an exaggeration, but I'm sure some of you feel that way. I've found it to be incredibly powerful. I am in a very fortunate place where I get to work with a lot of different organizations and programs all coming at it with a slightly different lens, and it's been really interesting to see different ways. We've had individual investments that prove not to be worth it, but overall, I'm in the better than expected bucket myself. So great. Well, I've spent a fair amount of time giving an overview, and thank you for all your results. I'd like to spend the next 10 minutes talking about 3 different examples, just to give, since many of you are learning, sort of show you what this actually looks like. And my first example is program driven. And these are based on true things. Obviously, I'm summarizing them at a very simplistic level, and some of these actually combine a couple of experiences that were very similar. So don't contact me afterwards and be like, hey, I want to get in on that investment in example one. Some of these are actually rather old, but this one is an example of a very program-driven one. And I think, as many of you know, rural health clinics and all health clinics, especially ones where large numbers of the patients are on federal assistance programs, the model is, and this is true for both for-profit and nonprofit clinics, the model is you provide the care, much like insurance, you provide the care, you bill for it. But with government programs, that lag between the provision of the service and the time that you get repaid by the government, whether it's state or federal government, can be really extensive. And if you just don't have the private insurance volume to make it up, it can really lead to severe economic challenges for the clinics. And so we see this time and time again where clinics have maxed out their credit. The cost of servicing the debt is high because they don't have a good credit scores. And so working with a consortium of healthcare funders, sort of like, how do we crack this problem? How do we help make rural communities have a more stable, sustainable practice? This isn't a very risky thing because the government's there. The money will come in. There's a lot of practice in billing Medicaid and Medicare, and we know that the money will eventually come in. So there's not a high risk of loss. And really the intention here is to deploy assets that we have. And so what we did in this situation, working with a number of funders, was create a revolving loan fund where each clinic could apply for and get a loan for bridge funding between the period in which they'd provided the service. And I think there's simple ways to do it and there are complex ways to do it. It sort of depends on the money, but the process involved clinics, documenting what the demand was, what the cash flow problems were, how they would use the funds. And again, we made this program available to both nonprofit and for-profit clinics because the beneficiary is not the clinic itself. It's the people who are being serviced by the clinic, so that's a charitable class. These are generally clinics that have a high percentage of people who are on Medicaid or Medicare or other government program, and therefore we're lessening the burdens of government. We're helping those individuals have access to care. We're ensuring continuity of care and then a quality of care that might suffer. So this is clearly charitable. We've established that charitable purpose. And then we make these loan funds and they're interest free. The goal isn't to make money and get a return on the investment, although you could have structured this that way to add a little bit to cover the costs. And we also recognize that there's often a shortfall between the cost of providing the care and what the government's willing to pay. And so again, we're not letting any of these companies profit or generate benefit to shareholders if they're for-profits based on our money. We're just trying to make sure that the patients have access to care. And so again, we set up this revolving loan fund program. People applied. We made loans interest-free. Again, I'm calling them loans because there's an expectation that they would pay them back. There is a provision for forgiving them if that made sense. But it really wasn't the objective to make them as grants that we might recover. So we set them up as loans. And this program actually, there are several programs like this that again seek to provide this bridge funding, and they've been working quite well. Many of the clinics, because it's sort of a cyclical problem, they will borrow more or less. They'll pay back some, like if there's high patient volume for a couple of quarters, the amount they borrow may go up, but then they'll pay it back as the money comes in. But they basically never pay it all back as long as they continue to provide the reporting and everything. So again, this is very much program driven. There's no intent to make money. It actually ends up costing a little bit of money, costs far less than a grant because we're just revolving the money. We're helping more and more clinics, but it's been a really powerful way to sort of stabilize healthcare in rural communities, urban communities as well. This example says rural, but certainly this isn't unique to rural communities. But anyway, this is again, I think of this as a program driven. You see, it's a loan, so it's not a grant, and so I lump it in sort of the impact investing category. My second example is return driven, and this is where a large nonprofit institution that I worked with very closely really started thinking about race, equity, diversity, and inclusion. And this is not new. There's many people talking about this, but like the way in which not just the investment management profession, who are those individuals, what are the companies we're investing in, and how do we bring a ready lens to that work. And again, no willingness to sacrifice return, that we should be able to do this work. We should be able to invest in ways that advance racial justice without jeopardizing return. So this is clearly out of the endowment, the investment portfolio. It's not grant making, it's not recoverable grants, but really taking an aggressive look, working with, changing the profile of the investment managers, being very intentional about, looking for racial justice, companies owned by people of color, other screens that really, the way the ESG screens on companies, like just asking the investment managers to look under the hood a little bit more, and not just what is the rate of return, but what is the rate of return and what are these other factors. Initial result, and then again, they rolled this out. They worked with their investment committee. They worked with their advisors. They were pleased with the results. They did frankly better than expected, and so now the board is thinking about, like, is 15% too tepid? Can we do this across the entire portfolio? Is there any reason why you can't apply this ready lens? And again, factoring in all the rules and everything. So, again, that's a pure market-based example, and again, using the endowment in ways to further the mission and values of the organization on the purely investment side. And my third example in the couple of minutes that we have left is a mission and return. And this is, there is a nonprofit working internationally to, on untreated sewage is a real problem for both human health and the environment. And so they identified a company in India that was prototyping technology that was really, much cheaper, both to manufacture and maintain, also created expertise and capacity at the local level, enabling governments to really address these problems without being dependent on, large companies and large infrastructures. The way they structured that was the initial investment was a below market loan. I don't want to say it was zero interest, but it was certainly close to zero interest to fund the research and development, to get proof of concept and get the technology. In exchange for that investment, they bifurcated sort of the future exploitation of that. And they said, in developing countries, we want you to absolutely, where the problems are most acute or the government is least capable of addressing them at scale, we want you to you have to make it available at or below cost. But then in exchange, you can leverage it commercially in developed countries. And that's sort of pairing the for-profit and the nonprofit world. The reason I say it's mission and return driven, the early investment was clearly driven by mission and an intent to get this technology off the ground so that it could then ripple across society and produce returns far beyond what the initial investment of the foundation was going to be. But because they also truly believed in this model and this company, at the time that the PRI became due, there was an option to convert it into an equity interest. At that time that happened, the organization had to ensure that all the charitable purposes were served by the PRI, and they kind of closed that out. They then had to do the due diligence on the investment side to make sure that the equity stake that they were going to then convert the debt into was consistent with their investment portfolio, met all the rules that they had around sort of managing their endowment, and they did. And so they converted that, that's convertible debt, they converted the debt into an equity interest, and they now, as part of their investment portfolio, own a stake in that company, which is continuing to, early stage still, but continuing to build on the R&D and do that work. So that, again, that's an example that sort of blends mission and return. So I Thank you. We're right at 1:49, and I know that was a tour de force through a broad overview. But thank you very much for your time, and I hope that you all gained a little bit of knowledge, and even for you seasoned experts, I hope there were a thing or two here that you picked up on that will help you think about your impact investing in the future. So thank you.
Thank you, Andrew. We really appreciate your expertise and being with us at our virtual NFP seminar. And for all those who are attending, if this is your first session, just as a reminder, you will need to log out of this GoToWebinar and click on the link back in the agenda for the next session coming up, which will be our last session for the day. And that will be starting in just about 10 minutes. So we'll see everyone soon. And Andrew, thank you again.
Thank you.